Good evening, good afternoon, everyone, and welcome to today's webinar. May I welcome Niti and Mr. Shivi to please come online.
Hi, good afternoon.
Hi, good afternoon. Thank you so much.
Good evening.
So friends, we have today a very interesting session, which is on, as you would know, investing globally and what is the importance of building a global portfolio. And for this, we have two eminent personalities from the financial markets, Mr. Siva and Ms. Niti Guhathakur. So let me take this honor and privilege of introducing both Niti and Mr. Siva. Mr. Shiva is head of investment advisory with Kristal, and he has 25 plus years of experience across the financial industry, and he has held senior leadership positions in various top organizations of the world. Most recently, he was the APAC head of risk solutions at Citibank, and based out of Singapore. He has also worked with leading institutions like JPM, PNP, Citi, HSBC, and MAS across Singapore and Hong Kong. He holds a master's in finance degree from NUS. Niti Guhathakur is also a CFP certificate and is a lead customer relationship manager and strategic programs. She also has 20 plus years of financial services experience, and she has been associated with leading wealth management firms over the years. She holds a postgraduate degree in commerce and also holds a diploma in law of corporate mergers and acquisitions. She holds an ICM CSI certification and is also a certified financial planner by FPSB. So welcome so much, Mr. Sivasankaran and Ms. Niti Guhathakur. Thank you so much for this webinar. I welcome you both, and I now request you to, please start. Thank you.
Thank you, Alok, for coordinating this webinar and inviting us. Friends, I am a CFP member since 2016, and this community has given me a lot to learn and grow. So a big thank you to all of you. I will start today's session by sharing my screen. Just give me a minute. So to start, I would like us to reflect on a very famous quote by Harry Markowitz. Diversification is the only free lunch in investing. What he meant was that while investing, diversification is the only thing you can do where you're more or less guaranteed to increase your return without taking on more risk. And this is so relevant to our today's topic. So let me start. What I'll do is I'll quickly brief you on the topics that we would be covering in our session today. So we'll start with benefits of investing globally, diversification across asset classes, geography, and product type. It provides protection for currency depreciation. It gives us access to latest global themes and also access to experienced global fund managers. Like it said, one must always study pros and cons before taking any decision. So how can we not cover the risk? So understanding risk would be very important. So risk would be like currency rate fluctuations, political factors, socio-economical events, limited information, and liquidity. I will now call upon my colleague Sivasankaran, Head of Investment Advisory, popularly known as Shivi, to take the session forward. I'll stop sharing my screen, Shivi. You can take it on from here now. One second.
Hi, good evening, everyone. Just give me a second while I... Anyway. Thank you. Thank you, Niti, and thank you very much, Mr. Alok, for this opportunity, and good evening to everyone. I'm based out of Singapore, and I've been here for the last 26 years. And what I wanted to start off with is to show you this chart from Bloomberg. It's the last 20 years chart, and it shows you normalized S&P 500 index and Nifty in local currency terms. Local currency terms in the sense, the white line is S&P 500 in US dollars, and Nifty is in INR. First thing to note is that, if we were to take 10 years ago as the base of 100, you can see how even in local currency terms, S&P is now at 349, which means it's increased by 3.5 times, whereas Nifty has increased by 3 times, 304. So 349 versus 304 in local currency terms. But the moment you look at it in dollar terms, so this is in local currency, dollar and INR terms, and this is in dollar terms, you can see what a big difference there is. In the last 10 years, obviously S&P 500 is still 349, but INR in dollar terms is only 175. That is 1.75 times. So straight away, firstly, on any any scale that you take, you will see that the S&P 500 has outperformed Nifty, and in fact, it's close to double of what Nifty has performed in US dollar terms. Of course, as you have disclaimers and everything, past performance is not any guarantee of future success. But I just wanted to highlight this because many times, when we take emerging markets, we are very gung-ho about how certain emerging markets are, just climbing one scale after the other. But in fact, if we were to compare it to the US markets, it isn't all that very impressive. Now, taking that forward a little bit, I just wanted to also talk to you, number one, the main reason about why diversification into foreign markets might make sense. And the main reason, of course, is as a hedge against currency depreciation. So, for instance, you could always buy gold, for instance, so that would have a completely different effect. But in this chart, what we're trying to do is to show you how much INR depreciated in all the various crises that we've had since almost the year 2000. And, the number of crises is, it's coming much more often than in the past. And you can see, for instance, let's start with the expansion from 2003 to 2007, which was really the bull market. And there, you can see how INR actually appreciated by 3.8%. And here we're showing it as a negative because we say dollar has depreciated against INR by 3.8%. But during the great financial crisis of 2008-2009, INR, US dollar actually appreciated against INR by 22%. Right. And then in the following years from 2009 to 2013, it depreciated by 1.6%. And then during the taper tantrum in 2013, it depreciated by 14.8%, and so on. So except for this period from 2003 to 2007, you can see how in the good years, for instance, from 2009 to 2013, as well as 2019, and we will include all the way now to 22, it has depreciated a little less. But fact is, it has depreciated. And when, in fact, there has been some sort of a massive turmoil in the market, it has actually depreciated a lot more. So that's the first thing to keep in mind with respect to why we think it makes sense to actually go overseas and invest overseas, because of it acts as a hedge. I mean, not overseas, I shouldn't say overseas. Why the US market specifically is a good place to go to act as a currency hedge. But obviously by that, just as a currency hedge is not good enough. So the second thing is to talk about efficient frontiers, which is what Niti started off her presentation with a quote from Harry Markowitz, and you're all obviously familiar with efficient frontiers. Basically, an efficient frontier, just if I may, recap quickly, you will have portfolio return on the y-axis, and you have portfolio risk on the x-axis, and this is a efficient frontier of all possible portfolios that can be made up of any particular set of assets. So, for instance, if you take pure INR assets, perhaps you could think of INR bonds and various types of INR stock, and you should imagine a lot of portfolios made up from all of these different types of assets, and think of a lot of dots somewhere here, and all the dots or different compositions of portfolios lying on this efficient frontier from the tip of this nose all the way up would be called efficient, and anything below all of this and whatever lies underneath would be inefficient, because at this particular level of risk, right, you will at this particular level of return, this particular portfolio that is on the efficient frontier has the least possible risk, right? Now, the point about adding global investments to your portfolio means that we've already seen how, even in terms of INR, the global markets as such have lower correlation to the Indian markets as compared to just adding more and more Indian assets to a portfolio. And if we were to make a global portfolio that has not only Indian equity, but also, in this case, US equity, what would happen to the efficient frontier is that it moves in the sort of north-westerly direction. And what happens now that you have this new frontier, right? It means that with the same level of return, I get much lower risk, or for the same level of risk, I get much higher return. Just by adding non-correlated assets to an Indian portfolio, you are actually moving the efficient frontier in a northwesterly direction, and that gets you a much more efficient set of portfolios. And that's all that we are trying to do when we think about portfolio diversification. And the quote from Harry Markowitz was, the only free lunch is diversification, right? Because here the free lunch as such is that by diversifying, for the same level of risk, we get a higher return, or at least, or for the same level of return, we can get lower risk. So our efficient frontier has moved a lot to the left. And actually, when we think of diversification, this is the single most important thing to remember. And if for instance, by diversifying, it means that all the portfolios were below this old efficient frontier, it means there's just absolutely no sense in diversifying at all. But luckily, in this case, there is a lot of efficiency or optimization to be had by diversifying into US markets specifically and global markets in general. So let's take that a little one or two steps further and see whether this is actually the case. So what we've done is, we have seen the performance. Now, the dark blue bar is basically Nifty, and the light blue bars are S&P 500. And once again, we look at those very same different episodes in history to see, what is the impact and how things turned out during these episodes. Now, I'd like to take two things. Yeah, first we look at two expansions. That is 2003 to 2007, when everything was going great, as well as 2019 to 2022. We had COVID in between, but if you start from 2019 and you again look at January 2019 to January 22, actually all markets are up, right? So in good times, and in 2003 to 2007 was a time when Nifty actually outperformed S&P by a lot, right? So fair enough. But in very terrible times like GFC, which is a global sort of impact, right? There, the Nifty fell by 53%, but S&P 500 fell by 37%. And if you take a much more local, that is a more Asia-specific or more emerging market-specific sort of episode, that would be taper tantrum and the China slowdown. And in both of these occasions, basically what happened is actually Nifty fell, but the US markets actually went up, right? And that leaves us with some other episodes where again more or less the US markets outperformed or were more or less equal. Now the takeaway from this is that as you would have as you all know, when we assess whether whether markets are going to go up or not, one is the intrinsic value of the market itself. How well the companies there are performing, what is the earnings per share, and things like that. But the other is also how demand and supply flows are going through the economy. So, for instance, most global funds would have a certain allocation to emerging markets, and out of that emerging markets, they will assign some to China and some to India and so on. And just a little bit of expansion in the amount of demand and supply to say 1% or 0.5% or whatever can make a very big difference to Indian markets itself. Because remember, all of these funds are at the margin because they're actually buying and selling, whereas a very large part of the market is just holding. So the top part, which is the marginal amount where there is buying and selling, is what actually controls the market. So when somebody comes in and buys, say, 0.5% of the market, it moves the market hugely because nearly 80-90% of the market is just static and people are just holding, right? So what moves the price is what happens at the margin. And that's what international investors, when they come in and they move the market, it's not so much about intrinsic value itself, but they might be under other problems. For instance, when you take a time like GFC, obviously the US was far more impacted than even India. Then why would India fall much more than S&P 500? And the reason for that is that when all of them are selling together at the same time out of emerging markets, and it's not just an India story, everywhere they were just selling out and taking the money back to the US because that's the flight to safety. If you have a lot of flight to safety, then all emerging market assets are all sold, and therefore their prices fall. And then it's all taken back to the US, although actually GFC's the source of all problems during the GFC was the US itself. So what I'm trying to say is that when we talk about diversification, unfortunately, at the emerging markets, basically what happens is that even though there might be no problem with the emerging market itself, the value of those emerging markets fall because of the fact that a lot of international investors are selling out and taking the money back, and that at the margin makes a huge difference to the market itself. So that's the point about international diversification. Yeah, one is the theoretical thing that if you have lower correlation, then you have a more optimized portfolio, but also the facts on the ground that during crisis, even if it is not the fault of the particular emerging market, at the end of the day, if there's a lot of selling of those assets by international investors, then that moves the market a lot. Much more than India. For instance, I'm based in Singapore, and close to us is Indonesia. So Indonesian bonds and Indonesian equity usually always get hammered more than anybody else, regardless of what happens in Indonesia, right? Because there's a huge component of international investors in Indonesia. And every time there is a crisis anywhere in the world, most of them have to pull back their emerging market assets. And the first thing they do is sell Indonesian assets. Yeah. And, most of the time, the Indonesian economy is actually quite okay, but even then they get hammered because of that. So it's not something that's applicable only to India. Now, I should say that as the economy and emerging economy gets larger and larger, which is the case with China, for instance, now, then it becomes a much larger asset class by itself. It is no longer considered, is not bucketed as emerging markets. It just becomes another entity by itself. And so that might have a slightly different dimension. And hopefully, India also will, in the next 5-6 years, become so large that instead of thinking of India as an emerging market, or even if they consider it as an emerging market, they don't bucket it along with the other emerging markets, and instead they just treat it as a separate asset class, in which case we might find some difference in any future sort of turmoil in the market. Yeah. So that's one thing also to remember, that so two things. Yeah. One is theoretically, diversifying overseas actually helps to overseas to lower correlated markets actually improves and optimizes an asset portfolio from a theoretical perspective. Secondly, during crisis, actually by having overseas assets, you're protecting yourself from any impact in Indian markets, whether the fault is with the Indian market or not. Yeah. The third thing is access to unique themes. Now, this is extremely important. Yeah. So today, suppose you have a purely Indian portfolio, and we saw during the whole COVID crisis that the lack of semiconductors was a big deal, right? Because the fact that they weren't, China was locked down, they were not producing enough enough chips, basically meant that even production of cars and so many other things ground to a halt. Now, they have the Internet of Things, IoT, and pretty much everything has a chip in it. And the moment that chip stops, the whole large segments of the economy just grind to a halt. Now, if you were based in India, what would you invest in to take advantage of the semiconductor story? There is no company that manufactures semiconductors. So, what is there to invest in? Neither the software of it nor the hardware of it that is specific to semiconductors, right? So, or for instance, if you were to take say mRNA vaccines, right? Only now there's one company, I forget the name, that has started manufacturing mRNA vaccines in India. But if you want to do it at scale, you can't even do it, because there is just no company that invests that manufactures these things. So when we talk about unique themes, that's what we mean. That is, there are large parts of the world economy and industry which are right at the forefront of various types of technology that if you want to invest in them, you necessarily have to sort of go overseas, because there's just no way you can participate in that sort of growth. And I would say, and that's a positive reason as to why one needs to be globally diversified. Otherwise, you just sort of miss the boat with regard to that. Still more other things. There are many alternative funds, and some of these alternative funds are in things like life settlement funds. Life settlement funds basically are funds which actually buy insurance policies from insurance companies, and then they have a lot of actuarial experience, and what they're doing is they're basically collecting a lot of the premiums that come from insurance policy holders, and they feel they can do a better job of managing those funds than the insurance company itself. And actually these funds do in a way have much more flexibility than insurance companies itself, because insurance industry is highly regulated, whereas these funds are able to buy not the whole thing, obviously they can't, but even if they take 5% from different insurance companies, they are able to generate much higher returns than the insurance company itself. So that is one sort of fund. Then you have carbon credit, then you have arbitrage funds, then you have hedge funds which do long short. So there are many types of funds which have very unique asset classes and very unique strategies as such, all of which are not available in India, right? So that's another reason why that one needs to think about diversification outside of India, right? Now, what we've done in a very sort of rudimentary way is to compare the returns of a global portfolio. And here we talk about where we have Indian assets of 40%, that is equity investment of 40%, 10-year India corporate index, that is fixed income of 40%, and NASDAQ of 20%. That's the dark blue. Whereas a domestic portfolio of say 50% Nifty and 50% corporate bond index, again, 50% fixed income, 50% equity. And you can see how, whether it's 3 years, 5 years, or 10 years, actually the global portfolio outperforms. Naturally, this is not a super scientific way of allocating, but we just wanted to show you that even a 20% allocation to NASDAQ here will just boost performance over any period that you want to see, right? And it's very significant. In 3 years, it's 14.2 versus 10.6. 5 years, pretty much the same, and 10 years, the differential is about 3.5 to 4, and that's something that's sort of consistent across time periods. And we should also look at volatility as such. And we haven't got the calculation here, but the volatility is much lower once you include the overseas US stocks specifically here. So if I can recap, basically, what we have is basically, from a theoretical standpoint, I've already shown you how the efficient frontier sort of moves in the northwesterly direction the moment you add more and more assets which are less correlated to the existing portfolio. And that's the first thing. The second thing is how during crisis, what happens is the Indian markets underperform the US markets, not because of any particular reason of the Indian market itself, but because in a massive global crisis, what happens is international investors sell Indian and emerging market assets and pull the money back to, it's sort of a flight to safety, as they call it, back to the safe haven of the US. And because they are doing it at the margin, that is, even if they're selling 1% of the entire stock market, basically what happens is that constitutes a massive portion of the actual buy and sell orders that are taking place. And therefore, that moves the markets a lot. And we also have the point that it's a great hedge against INR depreciation versus the US dollar. And on the positive side, it offers investors an opportunity to participate in the frontiers of science, which many of which industries are not even present in India. And lastly, it also has a lot of different types of products, for instance, structured notes, alternatives, Elon's bonds, etc., which are all products which are not available in India. Bonds are available in India, but I'm talking about a really diversified sort of bond funds and things like that, right? So in all, whether you take it on the positive thing of when there's growth and when there's opportunity and where to invest and how to invest, all of those things are the positive aspects. And then even in times when there are crises, it does better. And overall, there's a good theoretical framework holding everything together. And that's, I think, one reason why more and more we find larger players, the amount of outward remittances has been increasing a lot. There was a little bit of a dip in financial year 2021 because of COVID, but otherwise remittances in general have gone up, and investments in equity and debt also are up there. Yeah. So some of this remittance, of course, is possibly just expenses like, education and things like that, and tourism and all that, which fell because of COVID. But if you see investments, that has really spectacularly gone up, right? It's just gone up from about 500 million in financial year 2021 to about 750 in 2022. And I think you must all be getting a lot of queries about investing overseas, and I don't see any reason why this trend should stop. Yeah. So I think, as Niti was saying, one very important factor is to remember the risks. So what are the risks? First is exchange rate fluctuations. So this is, to some extent, we have seen a sort of secular decrease in INR value, INR value against the US dollar for the longest time. On average, say 3 to 5% per year, but not consistently, not in like a straight line, but sort of waving. The only consistent period of appreciation was pre-2007. Yeah, since then it has been sort of appreciating. Could it change? I mean, anything is possible, but possibly unlikely as well, because an orderly, as long as you have inflation of 5 to 7% in India, and of course, we have much higher inflation in the US. But just before January 2022, the average inflation in the developed markets was not even like 1%. And we were at, say, 5, 6, 7%. And that reflected in interest rates. And that, therefore, makes sense that the currency also depreciates to that extent over a period of time. We'll see how things go in future, whether inflation is embedded and become and how long it will take for America, for instance, to get rid of inflation is something that is a topic of very, very great and deep discussion across all possible markets. But I mean, all possible economists and universities and banks and elsewhere. But I would say also that, for now at least, a sort of standard change in exchange rates, a depreciation in exchange rates is something that one has to sort of factor in if you take the medium term. The other one is unforeseen political factors. Now, this is important if, for instance, we are dealing with, say, investing in China even, or any place where the global or where the political systems are a little not so well established. Of course, you could argue that when Trump was there in the US, there was political factors, but so that's one thing. Suddenly, for instance, there could be some change in policy, like immigration or funds moving in and out. All of those things can happen. As you know, in Russia, for instance, sadly out of the blue, what the Western world has done is to stop settlements using the SWIFT mechanism, right? And then immediately that delegitimized a lot of the US reserves that Russia had. So that was a big impact. So those sorts of political factors are there. Then there are social and economic events, all sorts of coups and all sorts of other things. And economic events in terms of right now, every month when we see the Fed, is it going to increase rates or not? What is the number of non-farm payroll? All of these things become so important, not only in the US now, it sort of reverberates across all financial markets in the world. So that's something. Limited information. Again, it depends on which country we are talking about, but I would say to a large extent, the advantage of many markets, and most importantly, US and even the UK, is very high standards of transparency. Not completely clear, and certainly by no means perfect, but as compared to emerging markets, by far, you can at least trust the numbers, and and a lot of things like insider trading and things like that have been massively stamped out. Again, I'm not saying it's perfect, but to a very large extent, one can trust the numbers, one can trust the market, one can trust settlement systems, all of those things. I mean, it's actually phenomenal in India as well. But, this is something that, you need confidence in a market. And so that would be very, very important. And lastly, liquidity. Again, actually, for liquidity, I would say there's nothing to beat US markets, right? I mean, they're just so deep, and not just for equity, but also for options, for instance. It's just a hugely liquid market. But there could be some pools of illiquidity. And, we have lived through some really scary times. For instance, in March 2020, there was actual, even treasuries were having a bit of illiquidity. So in those sorts of events, the game is up for pretty much everyone. But relatively speaking, there is a much higher liquidity, but there could be issues there. So one thing to note is that when we think of Indian markets, we might be familiar with many of the risks, and there might be some other risks that are there overseas that one might not be aware of. So that's something that definitely one has to consider. And then, suddenly, there could be change in Indian regulations with respect to investing in overseas markets. So that's another factor also to consider. So one has to take into consideration these things before we actually go ahead and invest overseas. Lastly, if I might just recap. So why? Because of global diversification is good, and it is especially good during times of turmoil. It has better portfolio performance and a sort of higher reliability in terms of lower risk. And it takes care of currency risk, and it gives you access to unique themes. And also remember, to unique types of investment vehicles, like those alternatives and arbitrage funds and things like that, which I was talking about. Why not? Again, you saw the risks. There could be exchange rate fluctuations, there could be limited information, political factors, social factors, liquidity, all sorts of issues. On balance, then, therefore, you have the risks and you have the sort of upside. And I suppose every investor has to take their own sort of counsel and see whether it is a risk worth taking. Over any length of time and any period, I think as long as we take three-year periods at a time, there has been no 3-year period in which it does not make sense to hold some portion of your portfolio in overseas assets. Again, when I say overseas assets, I mostly mean US markets, but it could also be other developed markets. Whether you want to invest in other emerging markets or not, again, in theory, because the more diversified it is, the more optimal the returns. But one should then the number of the weightage of risk becomes a little higher, and one should have a much more convincing case before they think about going into other emerging markets. But on balance, there is certainly, in Markowitz's words, there is a free lunch to be had by diversifying into developed markets at least. So with that, I will hand it over back to Niti. Yeah. Niti, over to you.
Thank you. Yeah, thank you, Shivi, for sharing insights and giving us a lot to reflect on. I'll just share my screen. Give me a minute. Yes. So today, I think clients and advisors like you all understand the need to invest in sophisticated products. But these products are offered by private banks, and clients require a minimum of 5 million or 10 million to participate. So, what happens to clients who are saving their first 10K and they want to put it for good use, maybe for their retirement, for their children's education? This question, I'm sure, would be in your minds, that where do we go and how can we change the rules of financial industry? This led to the birth of Crystal.ai. As you see, the aim is to make private banking products available to everyone. You can have your account at zero funding, you pay as you invest, and the fees is extremely competitive. I will also give you a quick overview on Kristal. So this is the brainchild of Ashish Chanda, the founder and CEO. Vineet Narasimhan, co-founder and CTO. We are regulated in Singapore, India, Hong Kong, and Dubai. We have 48,000 plus customers and 1.2 billion advisory under management. So Kristal is a digital platform offering private wealth management solutions to accredited clients and retail clients. It is enabled with hybrid advisory, which is robo-advisors on one side and human-led advisors on the other. We are using technology to deliver personalized investments. So to my mind, Kristal is not just a wealth platform. It is a wealth revolution. And I would sincerely request you all to come, explore, and let's make this, let's give this access of sophisticated products to everyone. That's for me. So do log on to Crystal.com and ready to answer any questions. You can also reach us at niti.guhathakur@Crystal.ai or support@Crystal.ai. We would be happy to answer any queries, any questions.
Thank you. Thank you, Niti. Thank you, Shivi. Really fascinating and very exciting to see those data and statistics. I particularly enjoyed, the efficient frontier wherein you moved, you included some global investments and how it moved. So the graphical representation was really nice and easy to understand. And I had a small query, maybe lame, but diversification to global markets, is it equally justifiable both in times of increasing rates and decreasing rates, or how do you look at it? I mean, for the diversification to global markets, I mean, we see rates are going up these for the last few months. So is it equally viable in both the times, or do we have to really keep a watch on that? You are on mute, Shivi. If you can unmute yourself, please.
Oh, sorry. So a very good question. Yeah, actually, I think at the start of each decade on NDTV, the economist Ruchir Sharma from Morgan Stanley has this very extensive session with Pranav Roy. And I always watch it, and that shows you how old I am if I've seen it so many times every decade. But he was pointing out that in times when the market slows, for instance, when rates start rising, and when oil reaches a certain level, that is lower level at that point of time, always emerging markets do better. And that was the reason why when we saw the charts in the year 2000, that is 2000 to 2010, more or less, if you take out the GFC, I mean, Indian markets outperformed the US markets. So, and it looks like we are going to be in that stage now, right? So already interest rates are going up, and there's a huge amount of apprehension about what's going to happen to stock markets in the US now. And, literally we're getting calls every day about what do we do and things like that. Will Indian markets outperform? Given current scenario, one can argue that, the US markets will do better. But coming to your question, I would say, although we are called Crystal, we don't have a crystal ball actually. So, because nobody can say the future. And some level of diversification, including a small part, will, I think, always help out a portfolio. It is true that you might lose and I can see one of the questions was, in the last 9 months, Nifty has done better than S&P 500. Sure, absolutely. But the time horizon to look at these things is through a cycle, right? 3 years, 5 years, perhaps. And not to if you look at the shorter tenor, I mean, it's anybody's guess whether some market will do better than the other. But if we take a longer term view, then I think having at least a portion in this in US markets might actually work out better.
Yeah,
I don't
makes
know.
sense.
Yeah.
No, definitely makes sense. I mean, I'm getting where it is driving from. It's right. Actually, we have to be patient. We have to stay invested. We have to follow the basic principles of investment. So that's right. And Niti, I had a question for you. I mean, which is of course from one of the participants, and which is how to convince people to invest globally. As an advisor, how should I convince my client to invest globally? I mean, what does it really require, for me to able to convince a client to invest globally?
Yes. So the first thing is understanding and working with the client on the overall portfolio construct. When we take a goal-based approach, when we explain and understand and also assess what the client's current income levels are, giving a proper asset allocation is extremely important. Domestic, yes, but a certain percentage of your portfolio diversified into global markets, its benefits. Once we explain that it's not about a product, so it's not about a product push, it's not about selling something to a client, or for that matter, even us. Just because somebody else has invested into a global market ABC product out of a fad or out of some competition we are investing, we have to understand the need of why it is very important and what will be the effect of that investment in our portfolio. Like Shivi said, it is not a short-term plan. How will it affect us in 3 months, 6 months, 3 years, 5 years? That is what is important to us. And that is what we should explain to our clients. And I'm sure they will relate to it. I've been getting a lot of questions on that. So I'm sure, all advisors would be getting questions on sophisticated products from their clients.
If I can add to that, there's also the point that, many questions that we get sometimes from Indian investors is that they are actually foreseeing a time when they might actually have dollar expenses as well, right? Kids going to study overseas and things like that. So, whatever comes out of that particular pocket of the portfolio can actually have some use in terms of, some actual expense that people might have. Yeah.
Correct. And then on the returns side, I mean, the tax part to the returns. So that also has to be kept in mind. I mean, you have to pay returns, you have to pay tax on the foreign portfolios as well as the, on the Indian portfolio. So all those tax laws are also, to be taken care of, right? Okay.
Absolutely. Absolutely.
Let me just quickly check.
So at Crystal.ai, the reporting system is such where you get a very comprehensive reporting. So right from the returns made, the entire cycle that when the funds were invested, how they have performed. So when you're filing your returns, these reports, which cover extensively every aspect, makes return compilation also very, very easy.
That's a kind of a tool, which becomes very necessary. I mean, end of the year, we do have to file our returns. So it becomes very important for us to know where we stand and all the documentation is in place. So thank you, Niti. Thank you, Shivi, for that wonderful session. And I don't see any other question as of now on the chat bot. So really appreciate both of you joining us, Shivi from Singapore and Niti from Mumbai. Thank you once again, and look forward to many more such sessions.
Thank you. Thank
so
you,
much for the
Alok.
opportunity. Thank you so much.
Goodbye.
Thank you.
Bye.
Bye.